Hello, dear students. Welcome back to Curious Commerce. Till now, in capital budgeting, we learned about NPV. We understood that NPV helps companies decide whether a project is profitable or not. But today, we are entering another very important concept called IRR. It means internal rate of return. Now, look at this slide carefully. The first question says, is there a rate of return where NPV becomes zero? Very interesting question, right? We know at lower discounting rate, NPV may be positive. At higher discounting rate, NPV may become negative. So naturally we ask, at what exact rate does NPV become zero? That special rate is called IRR. The second point asks, how do companies find the project's true return? Students, companies do not simply look at profit amount. They want to know what percentage return is the project generates. That percentage return is IRR. So, in simple words, IRR is a project's expected earning rate, and this becomes extremely useful in investment decisions. Today's video, we will give you the complete foundation of internal rate of return. Before understanding IRR deeply, let us connect IRR with the NPV. The first point says NPV depends on discount rate. This is very important. Suppose discounting rate is 8%, you may get positive NPV. Now increase rate to 15%, NPV may reduce. Increase further to 20%, NPV may becomes negative. So the discount rate and NPV are directly connected. The second point is change rate leads to NPV changes. This means whether discount rate changes, present value calculation also change. And because present value changes, NPV also changes. The third point is at some rate NPV equals to zero. Exactly. Between positive NPV and negative NPV, there must be one point where NPV becomes exactly zero. That point becomes IRR. This is the main logic behind internal rate of return. Now let us understand the exact meaning of internal rate of return. Very important exam question. Now look at the second point. Rate at which NPV equals to zero. This is the definition of internal rate of return. At IRR, present value of inflows becomes equals to present value of outflows. That means no extra gain, no extra loss. NPV becomes zero. The third point, project's expected return rate. This means IRR shows how much percentage return the project can generate. For example, bank fixed deposit may give 7%. Mutual fund may give 12%. Business projects may give 18%. Internal rate of return helps compare such returns. Managers love IRR because percentages are easy to understand NPV equals to zero means it is easy to know what percentage will be the benefit for the projects. Now let us understand the most important decision rule. If IRR is greater than required rate, we accept the project. Suppose company expect minimum of 12% return. If the project IRR is 18%, project earns more than the required expectation, so company accept that project. The second scenario is IRR is lesser than the required rate. Reject the project. Suppose required return is 15%, but project IRR is only 10%. Project is not generating enough return, so project is rejected directly. The third point is compare with the cost of capital. This is very important. Cost of capital means minimum required earning expectation of company. IRR must be compared with that IRR greater than the cost of capital. Why IRR matters? Why the internal rate of return so popular in finance? Why IRR is matters? The first point is percentage return. People easily understand the percentage. If I say project gives 22% return, everyone immediately understands it is attractive. The second point is useful for companies' projects. Suppose project A gives 14%, project B gives 19%. Very easy to compare. The third point is widely used in practice. The real companies, banks, investment firms, finance managers all use internal rate of return regularly. That's why IRR is considered one of the most important capital budgeting method. Now let us understand the internal rate of return logic. Higher discounting rate reduces the NPV. Why? Because future cash inflows lose present value when discount rate increases. So NPV starts falling. The second point is find rate where NPV becomes zero. This becomes our target. That rate of internal rate of return, simple. IRR is balancing point. Before IRR, NPV is positive. After IRR, NPV is negative. At IRR, NPV is zero. S- Now let us take a simple illustration. At 10%, NPV is positive. This means project is profitable at 10%. At 20%, the project is negative. Now the project becomes unattractive. So what conclusion can we make? That is IRR. IRR must lie somewhere between 10% and 20%. This is the basic trial and error logic used in IRR calculations. And in the next video, we will learn exactly how to calculate using this method. Now let us revise the full IRR decision rule. If IRR is greater than cost of capital, we accept the project. If IRR is less than the cost of capital, we reject the project. If IRR is equals to cost of capital, company becomes indifferent, meaning no extra benefit, no extra loss. This is one of the most important theoretical rule in capital budgeting. Very important for exams and as well as the interviews. From the manager's perspective, IRR is extremely useful. Managers prefer percentage language. IRR shows projects returns in percentage, and it is easy for decision makers like the board of members, investors, executives all understand percentage quickly. The third point is used along with NPV. It is very important. In real life, companies rarely depend only on IRR. They combine NPV, IRR, payback period, ARR, or any other better decisions. Students, now let us clear some confusions. IRR is not profit, correct? IRR is percentage return, not actual rupee profit. Once again, I will repeat, IRR is not profit. IRR is percentage return, not actual rupee profit. IRR is not cash flow also. Cash flow is amount of money. IRR is percentage performance. The third point is it is a rate, not the amount. That's very important. IRR always comes in percentage form like 12%, 18%, 25%. Never in rupees. Now let us quickly revise today's lesson. IRR means rate where NPV becomes zero. It is used for decision making, comparing projects, understanding projects, and remember, NPV is considered the best method. IRR is usually considered the second most important method. But in practical businesses, both are used together. In our next video, we will learn IRR calculation using trial and error method. This is where practical finance really begins. We will solve problems step by step, understanding calculation clearly and make IRR extremely easy. Thank you, dear students. Keep learning with Curious Commerce. Stay curious, stay ahead. This is Curious Commerce. Please like, share, and subscribe. Once again, thank you all.